Hi everyone and welcome. Thanks for joining us. I'm Chris Ashton, the head mentor at the Corellian Academy. Today's session is the first of 5 webinars I'll be running across the rest of 2025, all focused on using technical analysis to help you trade CFDs on the Plus500 platform. Our topic today, technical analysis techniques when markets aren't trending. In other words, how to identify and trade sideways markets. Now, before I move forward, just a few housekeeping points. The webinar will last approximately 20 minutes. There will be a Q&A session at the end of the presentation, and Richard Adcock, the Corellian Technical Analysis Mentor, is with me today. So feel free to add your questions to the Zoom chat or Q&A that you have access to. Please note that trading CFDs involves risk, and this session is for educational purposes only. It is not financial advice. Now, why start this series of webinars with this topic? Well, sideways markets are important for traders. Not all markets trend. In fact, they often spend long periods in ranges. These periods can be frustrating if you expect a breakout, but if you know how to read them, they can provide clear, repeatable opportunities. Over the next 20 minutes, I'll discuss the chart types available for you to use on the Plus500 platform and how they can help you spot range behavior. I'll cover the basics of support and resistance, including how understanding these terms can support your trading. I'll run through the characteristics of a sideways range, and then I'll use a current example of gold as a case study to explore sideways trading strategies. And then I'll finish by outlining the concept of a supply-demand vacuum and how it drives moves in CFDs that you may be trading after a range breakout. Right, let's get started. Now, as it's webinar 1 in this series, I'll start by looking at the different chart types, or the most popular ones that you have available to use on the Plus500 platform, because each one offers a slightly different perspective on price action. No matter if you're looking at a weekly, a daily, a 1 hour, or a 5-minute time frame, it's important to note that all the chart types I discussed today can be used across any of these time frames that you may be trading or analyzing. They all offer the same value in terms of market activity because they all look at the same thing, and that's price. But they all look at it in slightly different ways and offer varying degrees of information to us as traders. The first and most basic type of chart is a line chart. On screen is a daily line chart of euro-dollar since April 2025. This type of chart only shows closing prices for the period being monitored. This is good as it's simple and great for spotting broad trends. However, it has some big limitations. While it's easy to see the price direction of euro-dollar using this line chart, because it only shows one perspective, and that's the closing price, it can mean we as traders might miss out on a significant amount of other important market information. Why is this a potential issue for us as traders? Well, it could be argued that by only using the closing price of euro-dollar in this example, I've given myself that tunnel vision from a technical analysis perspective. I'm so focused on the closing price, I'm not aware of anything else that could be of use to me. This means I could be missing out on very important aspects of price activity, such as intraday highs and lows, or turning points in price across the period being analysed. This type of information can be very important for traders to know, as it's these key levels at which buyers and sellers have been their most active, battling it out for the supremacy over where a CFD that you're trading moves next. One possible solution to this is to use the second type of chart, and that's the bar chart. This one shows the open, the high, low, and the close. And you can see these points highlighted to you on the euro-dollar daily chart on screen. The bar chart offers a much better feel of price action and can be useful as it pinpoints more effectively the key levels where turning points within price action have been seen. In terms of offering more reliable information about price and possible market trends, I would argue that as traders, no matter what time frame we're looking at, the bar chart is superior to the line chart. However, there is a third type of chart which I believe can offer an even stronger insight into price activity, and that's a candlestick chart. While the candlestick chart uses the same information as a bar chart, the open, the high, the low, and the close, it presents it in a way that offers a greater insight into market sentiment, as well as highlighting where turning points have developed in price. This is why at the Corellian Academy, we prefer using candlestick charts for our market analysis, and while the charts within the rest of today's webinar will be candlestick charts. So after that big build-up, let's discuss how candlestick charts can potentially make it easier for us as traders to see how a particular CFD's price has moved and offer us that extra insight into market sentiment for the time period being monitored. To get a better feel for the price action of a CFD, candlestick charts place emphasis on how the current period has closed in relation to where it opened. When I've referred to period in this context, that's the time frame being monitored. So if we're using the daily chart of euro dollar as an example on screen right now, that is 1 day. Candlesticks charts color code each time period of price activity. If the period ends above where it began, the candle is colored green, as you can see on screen, a potentially bullish move. While if the period ends below where it began, the candle is colored red, a potentially bearish move. The larger the candlestick, the more significant the buying or selling has been for that period. If we look at the euro dollar chart again, we can see how the larger green or red candles have developed over this period since early April. We can assume that market sentiment has been more positive through June, while more negative through July, giving us a much better feel for price direction. Highs and lows on candlestick charts are shown by the vertical lines above or below the real body of the candle. And these vertical lines are called the shadow in technical analysis. The upper shadow for the high and the lower shadow for the low. And you can see these highlighted for you on screen on the dollar yen daily chart since April 2025. These shadows make it easy for traders to assess where strong buying or selling has been found, as rejections from highs or lows leave a longer upper or lower shadow on the candlestick chart. These highs and lows also provide an insight into support and resistance levels to look for in the price action of a particular CFD, something that is so important to be aware of when you're trading. Now, before I move on to discussing the basics of what you need to know for support and resistance, I just want to recap this chart section. Each of the 3 charts I've discussed are useful for traders in their own way. The line chart is great for the big picture. If, for example, you want to just look at where the NASDAQ 100 has closed over each period and want to see simple trends in price and not be distracted by other factors, the line chart is useful. The bar chart adds that next level of detail. If you want to know what has happened during a particular NASDAQ 100 session, for example, or over a period of sessions, a bar chart will allow you to see in a much more detailed way the highs and lows in price action, but perhaps more importantly, where turning points have materialized in price. Then finally, the candlestick chart provides all of the detail that a bar chart does, but then it takes it one stage further and adds market sentiment, with the color coding of the candlesticks either green or red. Okay, that's the recap. Let's move on and talk about support and resistance. Now, you may have heard of support and resistance before in other webinars or read about it in chat rooms or on social media. However, let's briefly discuss what these terms mean and how they can help us with our trading. Support reflects a price low, a level where buyers have previously been found and have successfully held even reverse price weakness back to the upside. In technical analysis, it is assumed if buyers have stepped in at a particular level before, they may be found there again. Resistance is a price high, a level where sellers have previously been found and have been successful in capping, even reversing the price strength of a CFD back to the downside. If sellers have been found at a particular level previously, we assume they may be found there on another occasion. These support and resistance levels often become self-fulfilling as traders react to them repeatedly while the identified levels remain intact. In this regard, support and resistance levels can be used to suggest where turning points may be seen in the future price activity of a CFD, and as traders, we can use this to help us time our trades. Using a daily chart of the USA 30 index as an example, if I had wanted to go long the index around the 4th of February, I could look at the chart and see that the current price activity is near a resistance level outlined by the January 30 high at 45,224. As it's possible that this level could cap the index again and potentially prompt some price weakness, I could have decided to hold off buying the rally, preferring instead to wait for a dip in prices to allow me to buy at a lower, more advantageous level. Using the same chart, if, for example, I'd wanted to go short the index a few days later on February the 9th, I could use the USA 30 chart to show me the sell-off is nearing a support level outlined by the February 2nd low of 43,963. As it's possible this level could hold again and see prices recover, I could have decided to hold off selling that dip and look for a better opportunity to sell at a higher price level. It is also important to understand that breaks of support or resistance levels can provide other important information from a trading perspective. For example, if a price level where buyers or sellers have previously been found is broken on a closing basis for the time period being analysed, so that's a daily basis if you're looking at a daily chart, a 1 hourly basis if you're using a 1 hourly chart, and a 5-minute basis if using a 5-minute time frame, there may be an increased potential for that move to continue in the direction of a break. A break below a previous support level can reflect negative market sentiment and the potential for further price weakness, while a break above a previous resistance level can reflect more positive market sentiment and the potential for further price strength. Using the daily USA 30 chart again as an example, we can see how this played out when prices broke below the previous support level at 44,007. And that's identified by the low from January the 26th, 2025. The support broke on February the 20th and prices accelerated quickly to the downside, highlighted by that long red candle, reflecting negative market sentiment. And the move then continued until a price low at 40,704 was seen on March the 12th. As a recap for this section, buying near resistance risk reversals, selling near support risks missing rebounds, but breaks of these levels can lead to momentum moves in the direction of the break. So being alert, staying disciplined when approaching these levels is critical within your trading. And we will cover this topic, breaking out from support and resistance levels and the resulting potential price activity, in greater detail in a future webinar. But for now, let's use the price action of gold from earlier in the year as a case study to outline when support and resistance holds price activity and how we can build this into our trading strategies. Looking at the daily chart of gold since May the 1st, if we apply these support and resistance basic principles to the chart, we can see that price strength has been capped at the 3,450 level, reflecting a resistance, with price weakness developing from this area. However, when downside moves in price have materialized from this 3,450 resistance level, since mid-May, any sell-off has been held by lows around 3,250, reflecting support, which has then seen price strength develop again. Gold's recent price action is a textbook sideways range. Prices have repeatedly bounced between these points over the last 3 months. The longer these support and resistance levels hold and dominate price activity, the more important they become for traders to be aware of. It is also true that the breakout of this range, when potentially seen, be it to the up or the downside, will likely be more significant in terms of price movement. So how can we use this analysis of gold within our trading? In this example, a sideways trading range pattern has developed where buyers have been found at the lower limits, or that support, around 3,250, and sellers have been found at the upper limits, or the resistance, at 3,450. The conclusion is that while gold remains between these support and resistance levels, the sideways range can continue. So first, we can apply that timing test. If our bias is to go long gold, but prices are close to the 3,450 resistance, we can assess whether it's the best time to buy. Or if, having seen gold find sellers at this level before, it may mean they will be there again, offering an opportunity to buy at a lower, more advantageous level. Vice versa, if our bias is to go short, but prices are close to the 3,250 support level, we can assess whether buyers could be found at this level again, providing an opportunity to sell gold at a higher level in the near future. Secondly, we can consider deploying a trade the range strategy. In this approach, we would look to initiate a trade entry just above to buy just above the 3,250 support, or initiate a trade entry to sell just below the 3,450 resistance, anticipating that this range will continue. If price strength does materialize from the support level we've identified at 3,250, or price weakness appears from the resistance at 3,450, we would then look to close long positions on rallies back towards that higher 3,450 level, or can close short positions on dips down to that lower 3,250 level. To practice good risk management, any stop losses on long positions would be placed just below the support at 3,250, while any stop losses on long positions would be placed just above the resistance at 3,450, just in case a breakout of either side does happen. And we would look to repeat this strategy until we lose confidence that the range will continue, or until a price breakout actually materializes. So, with this in mind, let's look at the mechanics behind why trading ranges extend for a prolonged period. Simply, they last because buyers and sellers cluster around support and resistance levels. Everyone has access to price charts after all. Over time, traders will adjust their orders to account for those identified support or resistance levels, reinforcing them. Eventually, one side gives up, and that will lead to a breakout. One reason for sellers continuing to be active at a resistance level is if they see that level consistently holding and reversing price strength back to the downside, which for gold, as we've talked about, is 3,450, they may be drawn to sell at this level themselves. If they are traders working sell orders above that resistance level, they may become impatient and lower their orders to just below that area to ensure that they are executed the next time the resistance is tested. There may also be buyers who are working bids to go long below that support level at 3,250. If they also become impatient and raise their bids above the support at 3,250, it means both support and resistance levels become stronger and are likely to hold price activity longer until either the buying or selling is no longer evident and a price breakout eventually from the range is eventually seen. So, this brings us nicely to the final part of the webinar, where I just wanted to look at what happens briefly when ranges break. Breakouts can be fast and sharp because of what's called a supply-demand vacuum. This vacuum develops because traders become impatient with not getting executed on their bids or offers, so decide to move them higher or lower to match the support and resistance levels, hopefully giving them a better or greater opportunity to see their orders filled. The more sellers that become impatient and move their existing sell orders lower first means that resistance level is strengthened, but it also means there is now an area above the resistance where there are no longer any current sellers. And this means there is much less to slow a breakout to the top side if it occurs. And this leads to what's called a supply vacuum as prices accelerate to the top side. If more potential buyers become impatient and raise their bids to the support of the sideways range, it not only strengthens that support level, but also means there is an area below the support where there are no longer any active bids or offers. And this means there is less to slow a downside breakout if it was to occur. And this leads to what's called a demand vacuum as prices accelerate to the downside. If we look back at the previous example of the daily chart of the USA 30 between late January to the middle of February 2025, we can see that the break of the previous support level from January the 26th is actually an example of a demand vacuum. Support had previously been found at 44,007, and that's the January 26 low, which held selling pressure on February the 2nd and again on February the 19th. However, look what happened on February the 20th when the support level gave way. Having seen potential buyers of the USA 30 index become impatient and move their bids higher just above that 44,007 January the 26th low to help extend the sideways trading range further. When the February 20 break was seen, it resulted in an acceleration to the downside until bids at lower levels were found over the coming sessions. And although while a short-term bounce did materialize into the March the second high, we can see that it was the break lower from the previous sideways range that reflected new negative market sentiment and a more extended phase of weakness into the March 12th downside extreme at 40,704. This is why when deploying a trading the range strategy, it's very important a stop loss is placed above the resistance, or in this example, just below the support, to protect your position and preserve your trading capital, just in case a breakout is seen and a supply-demand vacuum materializes. So the takeaways from today's webinar: use chart types to read both structure and sentiment. Identify support and resistance levels for better timing of trades. Sideways ranges can be traded successfully, but with discipline. Always protect positions with stop losses above or below those key support and resistance levels. And breakouts from ranges often accelerate due to the supply-demand vacuum. Looking forward, if we look at gold specifically, from a technical viewpoint, prices are currently still trading within that more balanced sideways range between support at 3,250 and resistance at 3,450. And this pattern may well extend further while these levels remain intact on a closing basis. However, if a confirmed breakout of either side does eventually materialize, be aware of the possibilities for a supply or demand vacuum above or below the support and resistance levels and the potential price activity that could follow. Right, that concludes the presentation part of the webinar. I can see there's lots of questions already, so that's great. Let's look at them with Richard.